coming. I suspect in the medium term shares will fall, given that there'll be some sticker shock. We saw something similar with the Hayne inquiry in the financial services a few years ago, where the regulator delivered a pretty scathing report and a number of share prices struggled for a year or so after that. So I suspect Star will probably suffer the same fate for the next 3 to 12 months. Hard to say. We haven't seen the penalty yet, but certainly not positive news expected by some, but for many it's probably in the too hard basket for the foreseeable future.
So buy, hold or sell?
It's a sell based on negative sentiment in the near term. There's probably easier ways to make money. Still more to come news-wise is probably going to be negative. So in the too hard basket for me in the near term.
Run. Is it too late to buy Graincorp shares this year? What do you reckon?
Look, for me, it's a hold. It has had a good run. It's been a bumper winter crop in Australia, 4th highest on record, according to the latest ABARES data last week. We might still get an upgrade for an even stronger winter crop. I think we're at 55 million tonnes. Potentially that could be a little bit higher. Another strong summer crop forecast as well, so back-to-back 5 million tonnes expected. So very strong conditions, and Graincorp has benefited because of this exposure to volume. So Graincorp has put out 3 trading updates this year, each time higher. Its profits will double compared to last year. The question now becomes what happens when conditions mean revert, and they will at some stage. The market or consensus is actually factoring that in, and Graincorp is trading at about fair value based on consensus. So for me, it's a hold. The good news is in the price. We're now waiting for the inevitable mean reversion, which might be 2 years away. But for now, I think Graincorp's a hold, but keep a close watch on it, because any pullback, it is worth owning. I can't predict the gold price. And I've had many people come to me over the years try and predict gold, oil, copper, and no one can do it with a great level of, they just can't. Often it's a pure guess, or you can do it short term, longer term, you can't do it. So for me, no, I would not recommend investing in pure gold, because I can't predict the gold price. If you have better skills than me, good luck, but it's a very risky strategy. Sometimes the gold experts tell me the gold price will be up this month and it's down. Sometimes they say it'll be down and it's up. And for me, that's almost pure speculation. So I would avoid a single commodity play in favour of a more diversified portfolio.
Would you look at Perth Mint Gold? It is facing some controversy at the moment. There's an AUSTRAC investigation over a bit of money laundering. You suggested you just wouldn't even touch gold.
Two reasons to say no. A, for that reason.
Yes.
And B, I can't recommend a single commodity play.
Okay.
I have no expertise, and I don't believe those who claim to be experts have the expertise for one commodity. For a basket of commodity, perhaps, but for a single commodity with something that might be a little bit tarnished, no, I wouldn't touch it. I think a lot of that's in the price, though. Just a few things I'd add. Has a very strong balance sheet with about 237 million in cash. So for a 1.2 billion market cap company to have 230 million in cash is actually quite a positive result. Last year it generated over 200 million in operating cash flow, and it's forecast the same again, or analysts are forecasting the same again in FY23. Again, 200 mil operating cash flow, 1.2 million market cap. That's quite significant, and it's got 300 million tax losses off balance sheet. So there's over 500 million in tax losses and cash in a 1.2 billion market cap company. So it's compelling value at this price, and it's got a share buyback in place, sort of putting a floor, if you will, under the share price. So yeah, a lot of the gold companies have been smashed. Perhaps there's at least good value in some of the bigger, more liquid stocks, but this company holds a lot of cash, generates a lot of cash, has a lot of tax losses, and is doing a buyback. I think it's worth a look at the current share price, so I think it's a buy. I agree, it looks cheap on valuation and it pays a good dividend yield at about 6%. I think it's a hold though, because they last reported in April, as Tim said, where they experienced a decline in the net interest margin. They're yet to report, so they'll report in October. Since then, we've had numerous interest rate rises and a lot of concerns crept into the property market. Is the consumer over leverage, et cetera, et cetera. So there's a lot of new information to come out in a few weeks' time. So I would actually wait for that, despite it being cheap. I would also prefer the larger players, because I mean they are trying to get scale, the economies of scale, without having the scale of the larger banks, which is easier said than done. I think consensus is actually pricing that in, hence the stock looks cheap. The risk is to delays and to the downside, so I would at least wait for the August result, which will be out in October. So for me, it's a hold if you need to own the banks. buy a bigger one, but for this one, despite being cheap, I would actually wait and see what they report in a few weeks' time and if they give an outlook statement.
Okay.
I think it's a strong buy.
A strong buy.
I think it's one of the most controversial stocks that I cover in terms of how many people look at it and how many people don't understand how non-cyclical it is.
Okay.
So I agree with most things Tim said. It is leveraged to Australian agriculture. It is diversified. It is all around Australia. So you might get a bushfire in Victoria, but you don't necessarily get one in Western Australia.
Yep.
You might get a flood in New South Wales. You don't necessarily get it in Queensland. It does farm input products, farm output products, financial services, cattle trading, wool trading, different banking, insurance. So it does multiple products to multiple farmers in multiple states. So it's a lot more diversified than people think. It is having a good year. What amazes me is that Graincorp has upgraded 3 times, double, forecasting double its profits. Nobody's worked out that Elders has got a strong result coming up. They've given guidance 30 to 40%. It's pretty clear from what their peers are saying that they're tracking top end of guidance. The data is out there. People are ignoring it because they're arguing conditions have peaked, conditions have peaked. Conditions actually, or the crop actually peaked 2 years ago, and Elders has grown its earnings by 30% compound since then. So conditions have peaked, they still keep growing. If you look at the last 7 years, since the current management's been in charge, the EBIT has grown by 30% per annum over that time. It's never gone backwards, or it declined by 1% once. So 2 years of drought, 2 years of bumper crops, bushfire, foot and mouth disease, all this stuff's been thrown at it, and its earnings have never gone backwards. So people keep telling me it's cyclical. I'm like, well, show me the history. Show me where this cyclicality has actually been delivered in the results, because the company's actually grown. So the way they've done that is through market share gains, what they call backwards integration, and through acquisition. So market share gains. Elders was once in bad bank. They were in the press for all the wrong reasons. They lost a lot of market share to what was then Landmark and Rural Co. Since then, those two brands have merged. It's the Bush. They support the little guy. Elders is now the little guy, the little company, along with all the independents. So they're winning back some of that market share. So to some extent, conditions can go backwards. They can still grow market share. Secondly, they've made great acquisitions in Titan Ag and Air, where they've been able to sell their own product, either manufacture more of their own products and keep the gross margin for the same level of sales, or sell their products through a broader network. Doesn't matter what's happening in the industry conditions, they're growing their earnings by backward integration. And thirdly, and this is what people forget, M&A. So part of their strategy is to grow through M&A. They loosely say they target 5 to 10% per annum EBIT growth, roughly half organically, half through M&A. So what I say to some people is, it wouldn't be terrible if ag conditions fell into heat, because then they can buy all these cheap businesses, because people who grew up on the farms and worked in the areas are having the issue that their children don't want to go into the business. So who do you sell to? Your kids are living in the city, going to city schools, want a city job. So companies like Elders and their competitors are buying these businesses for lower multiples than they're trading at. So if there was a downturn in the ag cycle, then that puts theoretically a whole bunch more businesses for Elders to buy, so the EBIT doesn't actually go backwards in a downturn. So for me, this is a strong buy, and they're a September year end, so they will report in November. What typically happens with ag is people focus on the June reporting companies through August. That's now largely done. We now turn to the July and September reporter, so ag will get a whole bunch of attention coming into the results, and I think you'll find the Elders result will be strong, and they'll give strong guidance for FY23, where the market's got them declining, and I just don't see it happening. So I think it's a strong
Tim,
buy.
tell me why you disagree with Philip.
Certainly sold a lot of newspapers. Big headlines, 80 billion could be wiped out. The analysis I did showed that foot and mouth has been in several countries for numerous years, for like the last 100 years. Different parts of Asia, parts of the US, UK, countries that Australia trades with, and it's never hit our shores. I went and visited one of the ships from Indonesia that visited Sydney over the weekend. You step on the footbaths and you wash your shoes, and no harm done. So we've drawn so much attention to this that the precautionary measures have all been taken. So this isn't the first time foot and mouth disease has hit the world, but we're all on alert, we're on high alert, we're all watching. The Indonesians have received the vaccines and government support, and they're now dealing with it. We've seen in the short term some live exports slow to Indonesia because they don't want to bring in expensive cattle to a potentially contaminated region, but it's never come out on our shores. So
you think reports of a traveller coming from Bali and it being on their shoes is a bit
Even if it did, so the worst case scenario was that basically wiping out the whole East Coast before anybody knew it was happening.
Mm-hmm.
Very, very low probability. Sells a lot of newspapers, but very low probability.
So it's still a very strong buy from
Absolutely.
you. Okay.
Absolutely, I have it as a sell. I would suggest so. For everything Tim said, any good news is largely in the price. There's not a lot of upside versus consensus estimates, or the good news seems to be factored in. We know relations between Australia and China aren't the best at the moment. We know registration can take longer than people expect. We saw earlier share prices had a nice little bounce. It comes, for me, it's in the too hard basket. There's easier ways to make money. It was once a market darling, no longer is so.
Talk to me about why it's too hard.
There's more competition, there's input costs going up, there's Chinese are facing reducing birth rates. They've got rising cost pressures as well, so the propensity for them to trade down to cheaper brands might occur as well. It's just easier ways to make money. And where's the upside? How can they, to gain market share, they have to spend more. As Tim said, it's a very competitive market. It's had a nice little bounce at current multiples. It's fair value at best. So where's the upside to own it from here? There probably isn't many. In a market where there's many cheap stocks, I would refresh the capital into something that's cheaper. One of the stocks we spoke about earlier.
Okay, a sell, buy, hold or sell?
I like it. I think it's a buy. It floated a year ago, so it's a relatively new company. It is, new to the boards. It's been around for over 100 years. It is growing material market share. So as I mentioned earlier, the Hayne inquiry really shone a pretty negative light on the insurance and financial services industry in Australia. They were the only insurer not named in the inquiry. They are very clean and they are award winning. Life insurance, income protection, they sell life insurance and income protection products. They are essential products. With property values the way they are, with mortgage rates the way they are, most families have got some sort of life insurance to cover their loved ones should they die and someone has to pay the mortgage, or should they not work. So it is an essential service. During the Hayne inquiry, it's a $17 billion industry in terms of premiums in life insurance. The direct component is about $11 billion. The rest is through group life. The industry lost trust, so people stopped renewing their policies, or chose not to renew with the name written in the press for the wrong reasons. APRA stepped in. Parts of the industry were bleeding a lot of money. Income protection was bleeding $1 billion per annum because people were charging aggressive prices to win business, and B, it became politically correct or socially acceptable to claim for mental health, so people did. So at the same time you had prices falling, you had premiums going up, you had customers removing themselves from the industry because they just weren't happy with what they were reading in the press. So the industry got a black eye. We're through that now. The regulator has stepped in. A lot of those players are merged or sold. The industry is returning to growth. So for the year to March, premiums grew 5%, which is better than the decline in the PCP. The industry is now profitable. NobleOak grew 40%.
Wow.
40.
Yeah.
So not by a little bit, they beat it by, they're small, they're 2% market share. But they're a large percentage of new business, like 18 to 20% of new business. So they are benefiting from being an award-winning, good service providing life insurance company who wasn't written up in the Hayne inquiry. And that growth is expected to continue for at least the next 3 years before they even make a dent in the larger players. And the best bit is, life insurers benefit from rising interest rates because their investments are invested in cash and fixed interest securities. Interest rates go up, they make a greater return on investment. So there's and it's cheap, so there's quite a few reasons to like NobleOak. I think it's a buy.
His points, do you take any of those on board?
Yeah, the bits that I don't agree with is the issues the larger players have had, exactly why NobleOak is benefiting. So the larger players were forced to sell because I won't name names, but there were larger companies continuing to charge people who had died a premium. So can you imagine, you hear that story, first thing you do is go and check your insurance policy if you're with that company saying, do I want to be with this company? Yeah. The person died, they continue to charge them a premium, so you do a switch. There's a reason why NobleOak doesn't sell through financial advisors. So financial advisors, their numbers have fallen. A lot of them have been managed out of the industry through additional trading, through usual stuff. Advisors often get an upfront commission and a trail commission. The upfronts are much higher, so every 2 years you might get a phone call saying, hey, we've got a new product for you, so let's keep switching and switching. And every time you switch, you need a blood test, a health check. So that annoys people.
It does.
So that's one reason why the consumer got annoyed with the industry. By going direct, by selling online, by having good customer feedback, you're not bothering people and you're less likely to churn. So I expect them to continue to benefit from that. And I kind of disagree. Insurance, picture the situation where someone has a $2 million property, $1 million mortgage, and your partner dies. What do you do? Tell me insurance isn't essential in that situation, 2 kids at school. Insurance, if you're overly geared or heavily geared, as many Australians are at the moment, is actually an essential service. And often it needs to be explained why people need it. Because the easiest thing is, well, if I die, I'm dead. So, well, what about your partner, male, female? What do they do? How do they take care of 2 kids? Sound like a life insurance salesman. I think it's more non-discretionary than people realise.
Yeah.
And at the moment, we've got full employment, so people don't worry about it so much. But what if there's a downturn? These interest rate rises are designed to get an outcome. So what if you can't work? What if you're overgeared? What if you've got a car loan as well as a home loan? Wealth management is about risk management, and I think this is an essential service. It grows at least in proportion to the population. Our population is ageing, and as people do their estate planning, they start to think about these things. So I actually think I'm stronger for longer. I think they'll be a beneficiary. And there might be some M&A. It won't come from the Australians who've been forced to sell. It might come from some of the offshore players who like what's happening to the market and how it's restructured. But to address Tim's concern about scale, a lot of their risk is reinsured away to the big reinsurers globally. So they don't need the scale because they leverage someone else's balance sheet. Their skill set is processing claims, managing claims, being good with their customers, providing support when they need it, and taking a margin off the premium, where probably a lot of it goes to the reinsurers who the risk is on their balance sheet, not on theirs. So that's how they get scale that perhaps a bigger player misses out because of extra costs that they don't have.
So a definite buy from you, but a sell from Tim.
Honestly, I would just rate it a hold, but for similar reasons, because they've got pretty solid. A pretty solid outlook for FY24 in terms of development profits coming through. I think it's about $7 billion or so coming through in FY24 according to consensus. 40% of their book is in apartments. That does worry me, but I think the stock is slightly on the cheap side versus consensus. There's probably a 15% return in it from here. So it's not a table thumping return, but it's not expensive like or fully priced like an A2 milk. So for me, it's a hold because the best case scenario isn't priced in. It's certainly not a must own, but I would consider it a hold and use it as a funding source if you found something better. Because the positives are there's a decent outlook for 2 years, and in this market where many companies aren't giving a 12-month outlook statement, someone who's able to give sort of a 2-year outlook statement, that is a positive. But for me, it's a hold. Certainly not a buy, and use it as a funding source if you found something better to invest in.
Okay. All right, well, let's look at our last stock, and it's from Jacob. It's Servcorp. It's a multinational organisation that sells serviced and virtual offices, co-working spaces, meeting rooms, and IT services. Philip, let's hear from you.
I think it's a buy. It's cheapest stock I cover. It's 300 odd mil market cap with $100 million cash in the bank. 1/3 of its market cap is in cash. It generates about 20% of its market cap in free cash flow each year. It's got a 6% dividend yield, and it's definitely I hate using this phrase, a recovery trade. You know, we're all waiting for the recovery trade, but you know, we are going back to the offices. Servcorp offers a flexible workspace model. That is the new model. You know, the demand for small companies to want, you know, longer term, large office space is lesser these days because of the uncertainty. So Servcorp offers the ability to take out 12-month leases on a per office space and to add more office capacity when you need to, or take it away when you need to. And there's various reports put out by some of the global property players saying demand for serviced offices is growing because of the flexibility. Servcorp's currently at 72% occupancy. As it goes from 72 to 80% as the world reopens and gets back to normal. A company already producing a lot of cash will produce a lot more cash. They grew during COVID, didn't go backwards. Their operating cash flow was up 55-60% despite COVID impacts. Again, one of the few companies to give guidance, but they're expecting profit before tax to be up mid-teens this year after a solid performance last year. So recurring revenue business growing, producing a lot of cash. I like it. It's single-digit PE. Its nearest comparable in the UK is a company called IWG Limited. It's on twice the multiples, 2 times. It's a $4 billion market cap company over there that could swallow Servcorp if the founder wanted to sell, which he doesn't. But it's on half the multiple of its comps, and many of its comps, like WeWork, which is, I'm sure most people have heard of WeWork, is losing $1 billion per annum. It's a no-brainer to own some Servcorp. I think at this price is very cheap with a strong outlook.